Hello and welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m. in the still very warm, very heat wave ridden, very summery Pacific Northwest. We are live on Facebook. Thank you guys so much for joining me. I hope everyone's doing well. I hope you guys are staying healthy, staying safe, staying sane. Very important to stay sane in a relatively insane world. And I hope you guys are doing great. Sorry, as I'm working through my home studio here, I am trying to fool with the blinds because the sun is poking in and lighting is challenging at best. So hope you guys are doing well. Let me see if I can move this around a little bit and try to get a little bit more sunshine on my suntanned face here. It's been a great summer. Hope you guys are doing well. I hope everybody is enjoying their summer as well. Summer in the Pacific Northwest, you can't beat it. It's absolutely glorious. As I've said time and again, if you've never been here for a summer, I highly recommend that you come check it out. It is absolutely spectacular. Just keep in mind that it is not like this the rest of the year. So don't be like the people from California who come up here and say, oh my gosh, this is glorious. This is fantastic. We should have this all the time. And then they move up here and come November, December, January, freak out quite a bit because it's it's not the same at the end of the summer. But anyway, having said all that, yes, I do feel like an ambassador to the city of Seattle, the Pacific Northwest in general, and I invite you all to come out here and enjoy a beautiful week or weekend or longer, whatever the case may be. That said, I want to jump in and talk about what's going on in the markets, what's happening with the economy, what's happening with mortgage interest rates and everything else. And I'm still fooling with my cameras here, trying to get a little bit more natural sun on my face here. In any case, things are not going great in the economy. I'm sorry to say it, and the reason why is because inflation continues to be a problem. It continues to be a burden, and as the markets and the Fed work their way through this, we're discovering, or they're discovering, I mean, we should have known all along, but people are coming to grips with the fact that this is a much more difficult problem and a stickier problem than anyone would have wanted to accept or state. And I've said it before, I'll continue to say it. Sorry guys, I'm still playing with the lights. Hopefully this is a little bit better. Our economy is massive. It is like a cruise liner. It is a very big, very bulky, very cumbersome, in many cases, very beautiful thing, but it does not move quickly, and it certainly does not turn quickly. And what the Fed has been trying to do for the last 15, 16 months is basically do a complete 180-degree turn. And that takes time. It's not like a speedboat. It's not like a jet ski that you just crank the wheel and it does a 180. This thing is a lumbering, gigantic beast, and it's a beautiful beast. It's a powerful economy. It's a massive economy, but it doesn't respond very quickly. And the Fed has been asleep at the wheel for so long in the months leading up to where we are right now, and in the months leading up to March of 2022, which is when they kind of woke up out of this fever that they had and came to realize that, wow, inflation is a real problem and it's a real burden. And now we're going to have to deal with that. And that's when they started cranking up rates. What happened most recently is the Fed had a meeting, and yesterday or the day before, they released the minutes of that meeting. So the Fed meets in private. Clearly, what they discuss and how they work on things. They can't have an open forum with too many people, too many prying eyes, too many ears, and so they meet in private. But then afterward, they release the minutes of that meeting and they share that information with the general public and the media, et cetera, et cetera. And that's what came out yesterday. And what happened basically, or what the minutes of the most recent meeting revealed, is that a lot of these Fed members, the majority of them, feel that we are still not overcoming the problem with inflation. They think that inflation is a big problem, bigger than they even had an idea. It's their job, of course, to know what this is all about. They dropped the ball, and if any one of us performed as poorly in our jobs as these Fed members have in their jobs, we'd probably be looking for a new job. But they're insulated from their mistakes. And so what they said in their meetings is that there is, I don't want to say consensus, because there are a couple of Fed members that think differently, but a lot of them think that number one, our economy is not heading into a recession. They think that we're going to prevent that from happening. Personally, I think that is wishful thinking. I think that they are dream casting. I don't like to say it. I don't want to believe it, but I can't help but think that our economy is going into a recession. And we're not going to have the quote unquote soft landing that the Fed is working to engineer. I hope I'm wrong, but time will tell. But what they do think at the Fed is that inflation is a much tougher customer than they initially thought. And despite the fact that they have hiked rates from basically zero in March of 2022 to now 5.5% on the Fed overnight rates, the most aggressive rate hikes in the history of the Federal Reserve Board, they still haven't contained the monster. They still haven't gotten the genie back in the bottle, the horse back in the barn. Use your metaphor of choice. It's really, they still haven't gotten it done, basically. And so they are thinking that they may need more rate hikes. The only time will tell on that. Their next meeting is in September, and September 20th, I believe, to be specific. And I believe that before that meeting, they're going to see another consumer price index report. That's the CPI. And they're also going to see another PCE report. That's the personal consumption expenditure report. These are two different measures of inflation. PCE, personal consumption expenditures, is the Fed's favorite measure. They each have different weightings for different components of the economy. But the one that came out, the CPE that came out for July, came out a week ago, and basically it showed that inflation was ticking upward, not downward, and that really freaked out the markets, and they've been on a negative slide ever since. I'll show you the charts in just a moment. The personal consumption expenditures is coming out next. As I mentioned, that's the Fed's favorite measure, slightly different weighting on different components of the economy, different sectors of the economy, but still the expectation is that it's going to show that we have room to work, and that we need to do some more work. The Fed needs to do some more work. So when they came out and said that yesterday, when members of the Fed came out and said that yesterday to the media, or the media saw the minutes of the meeting, it sent the markets in a very negative direction. Let me show you what I mean by that real quick. Hang with me one second. For those of you who know me, you know that I'm analog. So we're going to try to find this, and I'm going to see if I can share my screen with you here. And let's see here. This is what I want to share. I hope you guys can see this. This is, if you can, or if you can't, this is the chart for the universal mortgage-backed securities. That's this instrument right here. Now, universal mortgage-backed securities are the financial instruments that people like me and my colleagues and my competitors and everybody in the mortgage space, this is the instrument that is created with the IOUs that we write, basically, that we deliver for our clients. So as I've explained before, I'll give you another overview. When you get a mortgage from me or one of my competitors or one of my colleagues, the buyer gets the IOU. They get the keys to the house. They sign the IOU that says they owe whatever, $500,000 at 7% interest or whatever the case may be. And then they move on down the road, they move into the house, they unpack, they paint the walls, they settle in. We have their IOU. We sell that oftentimes to Fannie Mae or Freddie Mac. Fannie and Freddie bundle up a stack of IOUs and sell them to investment houses, to pension funds, to 401ks, et cetera, in the form of mortgage-backed securities. And this chart that you're looking at right now is a chart of the price of a mortgage-backed security. So if you were to buy one of these things in the open market, the price would be $97.50. You can see that right here on the right side. That's kind of where this line is. Now notice that this little green wick dipped even below 97.50 to 97.31. That's earlier today. That's the price of the instrument today. Notice the direction of this chart here. This was the day last week when the consumer price index came out and said, hey, inflation went up a little bit rather than down a little bit year over year. And notice the negative slope on this chart. It's pretty hard to miss just how unfavorably the market reacted to that information and continues to react to that information. Now, what's interesting about bonds, without boring y'all to death, and I fear that I may have already done that. What's interesting is that they're upside down, meaning that when the price of the bond goes down, the rate of interest that it delivers goes up. So it's an inverted relationship, price to rate or yield. So when you see something like this, it's not good news. Let me show you a different chart here. This is the 10-year Treasury note. This is one of the most correlated government debt charts or government debt instruments. The 10-year Treasury and the universal mortgage-backed securities are not the same thing, but they run very, very close together. So they kind of run hand in hand. They're like siblings. They're not identical twins, but they're definitely siblings. Now, this chart for the 10-year Treasury note, this shows the actual interest rate of the instrument, not the price of the instrument. And so once again, you'll notice a very positive slope on this thing, meaning that the interest rate, excuse me, the interest rate has gone up. Once again, this is August 10th. This is the day that the consumer price index came out for the month of July, showing that inflation year over year was still trending upward. And it was a major sell-off of Treasury notes. And again, when they sell the notes, when they sell the bonds, when the price goes down, the rate goes up. And so we've seen this. Now we're in very, very tricky territory up here because if we're testing this high right here, this is for 4.34, 4.33. That is technical as far as like how this is all calculated and how this all works. But the yield, the interest rate on the 10-year Treasury is testing the highs that were set in October of 2022. And what that means in general is that interest rates are going up. It's just that simple. Interest rates are going up. To what degree? This does not make me happy. So the smile on my face is not a smile of happiness or of joy. It's just, I'm a friendly person. But I'm seeing from some of my rivals in the industry that some of their rate sheets are showing the 30-year fixed, if not at 8%, very, very close to 8%. If you're not at 8%, you're at 7.5% or 7 5/8% or 7 1/4%, but you're being charged points. And a point is 1% of the loan amount. So 1 point equals 1% of the loan amount. So if you're borrowing $500,000 and your lender is charging you 1 point to deliver the interest rate, they're charging you an extra $5,000 just to deliver the money. That is very uncomfortable for a lot of our clients and for a lot of my colleagues, my rivals, myself as well, keeping in mind that we went 2 years ago, we were at 2.875 on the 30-year fixed. And now we are pushing well into the mid sevens, actually threatening to touch 8% and possibly charging points, fees to deliver money at that cost. That's not great. I don't know anybody who's going to say, yay, that's fantastic. In fact, even the people, the institutions that stand to collect interest at 8% or 7.5% or whatever the actual rate is, they're not happy about that either, because they know full well that the moment someone has an opportunity to refinance out of that debt into a lower interest rate, they're going to do that. And so, yeah, you might have an IOU that is paying you 8%, but you're not going to hold that IOU for very long, because the moment that there's an opportunity to exit out of that through a refinance, that client, that in particular borrower is what we call them, they're going to refinance. If there's even a remote possibility to do so, they're not going to stick around at that interest rate any longer than they absolutely have to. So even the institutions that buy these mortgage-backed securities at these interest rates, they're not all that thrilled about having the debt either, because they know that this is not something that people are going to spend a lot of time paying. They're going to look for a solution and a refinance as quickly as possible. So that's what's going on right now in the market. I wish I could share some better news with you, some cheerier news. If you see the sunshine over here, it should be cheerful, and yet it's not. It's really frustrating to see what's going on here. Now, what are the people at the Fed? Let me check our time. Okay, we're doing good. What do the people at the Fed have to say for themselves? Well, they say that there's more risk in inflation, more upside risk, meaning that they feel that inflation could continue to go up. Now, that is a huge concern, because the Fed doesn't have too many tools, guys. Like, the Fed may be very, very powerful, but they don't have a lot of tools. It's not like the Batman utility belt that's got all these cool gadgets and things like that. They've got just a handful of options. And once they've exhausted those options, if things don't come under control, then what? Like, where do they go from here? They don't have a secret phone that they can dial 911 for help. They are pretty much just working within the limits of what the Fed toolbox allows them. And that's not a lot of options. One of the things that they are saying is that they would very much like to see unemployment go up. That is a big deal to the Fed. Now, I've said this before, and I'm going to say this again. These things sound horrible. When I say it myself, when I internalize what that actually means, when I internalize that the Fed wants to see a higher rate of unemployment, that means real people losing real jobs, not being able to make their rent, not being able to make their car payments, not being able to take vacations, not being able to buy the things that they need to purchase, looking for, another job in an economy that is struggling. That's not good for anybody. I don't, there's nothing positive I can say about that. I'm a positive person. I like to smile. I like to think big picture, everything's going to work itself out. And I truly believe that. But at the same time, the Fed themselves are saying that they want to see a higher rate of unemployment. And this is kind of where things are just butting heads right now. Because on the one hand, that's what the Fed wants to see. And I'll tell you why in just a moment. But on the other hand, a lot of employers are holding on to their employees as best they can. They're not letting people go just yet. They're not having mass layoffs. Now, we've started to see some, to be sure, but we're not seeing the numbers that the Fed wants to see. Now, the Fed looks at unemployment numbers. There's a variety of different types of numbers when we talk about unemployment. We talk about things like first-time claims, right? That's people that were recently let go of a job and they're filing for unemployment benefits for the first time. That's one measure. Then there's continuing claims. That's people, obviously, who have filed previously for their first-time benefits, but they still haven't found a job and they're looking for more work, but in the meantime, they're filing for ongoing, continuing unemployment benefits. There's other metrics as well. I won't bore you with all the details, but what I will say is that the Fed wants to see higher and higher unemployment. The Fed is, it's made up of people, and I'm not going to say that these are bad people or good people. I don't know these people, so I can't point a finger and say that. But the Fed as an institution is like every other institution. It's faceless, it's nameless. In many cases, it is heartless insofar as they don't care about you or about me, about your neighbors, about your siblings. They look at the statistics and they look at the reports and they look at their own mission. And they, the institution of the Fed and the voting members of the Federal Reserve Board that are in charge of trying to contain inflation, they believe that the more people are not working, the less people have money to spend. That's the rationale behind this unemployment, this push for greater unemployment. The idea behind it is that if you are not working, if you are looking for a job, then one of the things that you're also not doing is spending money on anything other than the absolute necessities, which is food, rent, and fuel. Right? You're not buying new clothes. You're not taking vacations. You're not buying new cars. You're not, you're not spending money on luxury goods. You are just basically in a holding pattern looking for new work. And if there's high rates of unemployment, when you do find new work, chances are, at least in the Fed's logic, chances are that you're not going to get a huge salary, that you're not going to get a bonus for coming to this new company, that you're not going to get a lot of money thrown at you to help you with your decision as to working for this company or that company. Chances are, at least in the Fed's twisted logic, they think that if unemployment is really high and people are relatively desperate for work, they're going to take whatever's being offered to them. And oftentimes, those employers and those companies will not be offering the peak of the salary pay scale. And as a result of that, again, according to the Fed and their logic, that is going to provide less income for the working people. The working people will have less money to spend, therefore they will not spend as much money, therefore the price of goods and services will have to come down in order to find that equilibrium, at which point working people will spend money on these items and the pricing will reset. And as a result of that, inflation will come down, because the interpretation or the definition of inflation in the Fed way of thinking is rising prices. That's how they look at things. So they look at the cost of used cars as an example last year, and they look at it this year and they're like, wow, used cars are a lot more expensive in 2023 than they were in 2022. We've got to make it so difficult for people to buy used cars, as an example, that the people selling used cars have got to cut prices in order to find a place where people buying used cars are going to feel okay to buy them. And by those sellers cutting prices, that's going to reduce prices and it's going to, quote unquote, reduce inflation. This is how the Fed thinks as a monolithic institution. I don't know the members of the Fed. I read about them. I see them in interviews. They don't know me and I don't know them. But this is how the institution thinks. Frankly, I think it's horrible. I think that they have been absolutely terrible at their job. I would tell them as much to their face if I was ever invited to hang out with them. Clearly, I'm not going to be invited to hang out with them, so it's easy for me to make that statement here as a keyboard warrior. But truthfully speaking, I think that the Fed is very, very culpable and guilty of a lot of mistakes and of creating a lot of boom and bust cycles through their policies. I further additionally think that the Fed and the members of the Fed have the benefit of never having had to make a payroll. These are not employers. These are not people who have to deal with real people in real life situations. These are, in many cases, attorneys, and in many cases, economists, in many cases, academicians, people from academia. They've never had to make a payroll. They've never had to fire people face to face, person to person, saying, hey, look, I'm sorry, we just don't have the capacity to keep you on the payroll. They've never had to do these things. So for them, I won't say it's easy, but it's certainly not personal. They are insulated from all of the repercussions of their poor policy decisions and their poor choices and their poor outcomes. They are not worried about where their next meal or where their next paycheck is coming from. Let me take a look at time. Okay, we're good. We're still within time here. Now, the real definition of inflation, and we can go back and forth on this as often, as long as y'all want, but the true textbook definition of inflation is printing or borrowing more and more money, an increase in the supply of money. And the only institution that can do that is government, whether it's our government or a foreign government. That's really the only way that the money supply is inflated. And we had 6 trillion new dollars come into our economy since the COVID-19 pandemic. That's 6 trillion with a T. That's 1,000 billion dollars. That's a lot of new money. And, we can go back and forth about the politics of COVID, the economic relief that was necessary, the lockdowns, this, that. I don't want to relitigate that. It's irrelevant at this point. But in my opinion, this is where inflation has come from. Not because the Fed's interest rates are higher or lower or whatever. Yes, that is a component of how you deal with inflation, but inflation has to do with the fact that our government has borrowed or printed a bunch of new dollars that are still in circulation. And as a result of that, people had more money to spend and they spent it. And as there's more money chasing fewer goods, the cost of those goods goes up. That's basic economics. Now, here's the scary thing. The money supply right now is really coming down quickly. Now, while that sounds like a very good thing, there's a lot of danger involved with this as well. There's a lot of pitfalls to the economy. Again, the economy is not a simple thing. It's not a straight line. It's not linear the way we like to think of complex things. I think of our economy to a degree like a bowl of spaghetti, right? Or a ball of twine or yarn or whatever. Things are connected in weird ways. It's not a straight line. It's not this goes to here. Sometimes it swirls around, it does loop-de-loops, it gets tied in a knot, it gets wrapped around some things. That's how our economy works. And when the money supply starts to really decrease, there are other consequences that could be lurking around the corner. And so while I am very optimistic that we will continue to close loans, to help our clients buy homes, that there will be a refinance opportunity down the road for all of us. I am also alert enough and aware enough and cognizant of just how complex our economy is and what is going on, at least at some level. I'm not a genius on this. I'm not an expert, but I'm cognizant enough and I read enough and I look at things enough to know that there are other shoes waiting to drop here. We're not out of the woods yet on this. And whatever else is going to happen, I don't think it's exactly what we're expecting is going to happen. So we have to stay loose with this. We have to stay kind of frosty. We have to play it by ear. We have to do the best we can with the information we have at this time. And that still means that people are buying houses. Let me check my time. Oh my goodness, we're almost there. It still means that people are buying houses. It still means that people are looking for houses. Like I've been saying time and again, despite all this craziness, people still need houses now more than ever. And they are still buying homes. They are buying smaller homes. Perhaps they're buying less expensive homes in some cases because interest rates and housing payments are higher, but they're still looking for homes. So if you've got a house that's priced right, that's located right, that's ready to sell, that's ready to be bought, there are plenty of buyers out there for that. And I will tell you that there are a lot more people waiting to get into this market, waiting for interest rates to come down, waiting for the inevitable crash that I don't think is coming. And I'll talk about that next week, unless something changes in the economy, of course. But there are plenty of people waiting to jump in here. So as hard as it is to buy homes right now, it's going to be even more difficult later on when interest rates do come down and more buyers come out of the woodwork. So, man, it's a strange time. It's a strange time. 2 decades plus I've been doing this. I've never seen a market like this before. It's very, very strange, but we will get through it like we always do. And we will be happier on the other side of it, like we always are. So until then, it's that magic time. I can't believe it, 30 minutes. I want to thank you guys for spending a little bit of time with me. I would like to invite you to come back next week. I will talk about why this is not going to be like 2008, unless something changes, not something changes in the economy, but unless we get some really pressing data. I will talk with you guys about the differences between 2008 and 2023, what a difference 15 years make. And I will share with you whatever other insight. But in the meantime, please reach me. Please ask me questions. Please feel free to introduce me to your clients, real estate partners. If you want to talk to clients about this and you just don't know how, I am your resource. So please don't be shy. Find me. You know where I am. Until then, I will see you next week on 30 Minute Thursday. Thank you again for spending some time with me today. Please stay safe, stay healthy, stay sane. And for those of you in the Pacific Northwest, get out there and enjoy this glorious sunshine. I will see you next week. Have a fantastic weekend and a great week ahead. Y'all take care. Bye-bye.